many people who are so enthusiastically wanted to attend the session. In fact, I am not surprised. Why? Because with the growth that for the better bandwidth, what I will do, I will switch off my camera so that uh, my voice is better. So, there are 500 registrations, I came to know, and that's very good. And that doesn't surprise me as such, because seeing into the growth of Indian economy and the way the investments are coming in India, definitely India is the place to be, and it had been a place to be for quite some time now. But with the efforts that the government along with RBI has been putting in with regard to liberalizing the whole framework with around the investments in India. You see, from internationalization of rupee to setting up IFSC, there's so much that is being done by the government to uh, make use of the opportunities which are available, and also it has been putting lot of faith in the stakeholders around. Now, to take this growth forward, everyone needs to come forward, and government is doing its bit, but the other constituents of economy like banks, professionals like us, CAs, CS, lawyers, CMAs, and people at the management level, at CF, people serving as CFOs, the promoters, everyone needs to do their own bit. The role each one of us play in the economy is different. Now, whatever role that we are playing, if we play that role uh, nicely, I think how work is done there only. So we, being the very important part of the economy, we need to play our own role, and not only as part of our professional aspirations, but I think as part of our moral and ethical duty of being the facilitators of understanding the law and making businesses easy to transact. It is our moral, ethical, and professional duty to excel in whatever we are doing. It's not only the individual aspirations, because we are the learned lot. We are the people who are educated, and it definitely, it is on us to think about the present, and we are the people who can frame future. So I request each one of you to take excellence not as an option but as a responsibility. Now, if I can ask you, if you are a CFO, why should your company have non-compliance? Why should be there any non-compliance? If you are a banker, why should the company, why should the bank have not proper policies in place so that none of the customer faced any problem for any investment outside India, or for any remittance, or when the money is coming in, none of the stakeholder, none of the constituent face any problem? Why should not the bank have any all the policies, procedures, checkpoints in place so that there is a free flow of the transaction? Now, if you are a professional, why you should not be able to help your client to navigate the transactions, the investments with ease? This is the responsibilities. And in fact, you see, gone are the days when the compliance were imposed. Now, investors are rating the companies based on self-governance, the culture of ethics, environment, social, and governance issue is becoming one of the most important issue. And FEMA, as you see, is not a revenue law. It's a compliance law. It's a governance law, basically. So, hence, we keep on emphasizing to the senior management, to the AD bank professionals that who are working in multinational entities, to undertake this exercise of due diligence with regard to regard to the Foreign Exchange Management Act, because it's very, very essential that the law is followed not only as it is required, but also in spirit. So let us today what we are going to understand is we'll take an overview regarding the due diligence under a Foreign Exchange Management Act. We will understand about what, why, and how, everything. Basically, what is due diligence? I mean, all of us know what is due diligence. Just for the sake of comprehensiveness of this transaction, this presentation, we'll talk half a minute about it. Why is very important actually. Why you being CFO, why you being banker, why you being professional should undertake this exercise of due diligence under the Foreign Exchange Management Act. And when the why is clear, how becomes easy, and how becomes we'll get, and we'll run through the process, like how we should conduct and how we should go about the due diligence under a Foreign Exchange Management Act. So what is due diligence? We all know that due diligence is an exercise basically to by which an entity is checked for the unintended non-disclosure, probable default, hidden illegal structuring, malpractices, or non-compliance of law or any other contractual terms. Now, how the due diligence under FEMA is a bit different from the legal due diligence, or you can say tax due diligence, because there are two-way things are happening here. One, that entity wise, that what type of entity is it, and also transaction wise. So as we go along, we'll understand that how this is a transaction, and this is entities are playing its role when we are undertaking the due diligence under Foreign Exchange Management Act. So reasons, there are various reasons that this due diligence should be conducted, and why is it required to be conducted. The first reason that we have is Indian currency is a partially convertible currency only. So what do we mean by partially convertible currency? So basically so Indian currency, Indian rupee is partially convertible. Why and what exactly is it? That as far as our current account transactions are concerned, they are allowed to be undertaken with more of ease and more of with less of compliances. However, our capital account transaction are regulated. So currency basically that is freely convertible can be traded without any conditions or limit. Generally, fully convertible currencies come from the stable and wealthy countries like US and Japanese yen is a fully convertible currency. Now, in addition to the major currencies, there are few minor and exotic currencies that are freely convertible, like the Canadian dollar, Australian dollar, New Zealand dollar, etc. So there are many benefits to the fully convertible currency if an economy can support it. Now, freely convertible currency can create more business and employment opportunities for foreigners, increase tourism, and gives the world ease of access to that currency market. However, my dear friends, the currency becoming a fully convertible currency is not that easy. It's like leaving your currency that anyone from outside India can claim the assets in Indian rupees. So, although it's good to have a freely convertible currency, fully convertible currency, however, until unless the Indian economy is matured enough to take any shock that may come out of this out of full conversion, it may not be a prudent idea to jump into the full conversion. Although we have been seeing lot of liberalization, rationalization of our currency happening, lot of restrictions with regard to the undertaking of capital account transaction is being reduced, as we saw as we saw off late in July that RBI decided to put in place the international trade settlement in Indian rupees. So that was till then allowed only in the foreign exchange. So all these things are happening, but they happen at their own pace. So since Indian currency is partially convertible, there are a lot of restrictions that is imposed in dealing with foreign exchange. Now since these restrictions are there, there are the people, the companies, the organizations which are coming from the freely convertible currencies, those jurisdictions like companies coming from US, Singapore, they don't understand the restrictions, and hence they may land into lot of non-compliances. Now, another reason for coming up for doing this exercise of the due diligence is that the FEMA has the extraterritorial jurisdictional rights. So it is not only the operations in India which falls into the jurisdiction of FEMA, but also the operations that the Indian entity is taking out, doing outside India, the accounts that the Indian entity has outside India, or the branch offices or agencies outside India of the Indian companies, or the activities undertaken by resident individuals outside India, they all fall under the jurisdiction of FEMA, and any non-compliance with regard to that also will trigger the non-compliance under FEMA and all the penalties and all. Now, another reason to take this exercise is that, FEMA as such is a very dynamic law. I know you will say that that FEMA has only 49 sections and out of which only 9 are operative. So it's a pretty simple law. So not exactly, because for all these 9 operative sections that we have, there are regulations that are governing those, and for each of the capital account transaction there are regulations. And FEMA as such is governed and administered by the AD bank, along with the and for administering that, the RBI issues the APDIR circulars. So if we want to understand this law, which seems to be simple but is not simple, there are notification, rules, circular, master circular, which have been now superseded by master directions, and so on and so forth. Now, as far as financial law of any country is concerned, and especially in India, because we are half convertible, changes are ever expected, and especially when the law itself is FEMA, which requires constant monitoring from RBI for providing the required growth impetus to Indian Inc. and for providing liquidity at the same time and keeping the current account deficit under control. And you see, the law relating to foreign exchange is of great importance to any country. The foreign exchange policies decisions are based on the detailed assessment of global and domestic macroeconomic situations, and as the economy grows, the growth needs of the industry gets increased, and this has to be there has to be a balance between the growth of the country and the industrial growth, and both have to go hand in hand. And FEMA as such, if you see, does exactly that. It's a complex act because it is governed not only by the central government but also by the Reserve Bank of India, and there are so many regulatory bodies in the central government that caters to the various legs of FEMA, like DPIIT, Department of Revenue, Department of Economic Affairs, and then we have Reserve Bank of India, which administers and regulates the law of foreign exchange management by issuing the rules, by issuing the regulations, as well as by issuing the APDIR circulars to the authorized dealers. Now, of late, the power of RBI, some of the powers of RBI had been shifted to the central government. So now, if you see, it's a complex act to comply and to follow. One of the most essential thing why of the reason of why the due diligence exercise is a good prudent decisions to take is that because there are transactions. It is not that if you are doing something, it will be only penalized, or you can do away with it by filing the late compliance fees or something like that. There are transactions this which are not allowed to be undertaken. So if there are activities which are not allowed to be undertaken, it will render the transaction void ab initio. So let us understand that with the examples. So this is a transaction wherein it is an order which came for compounding. Now in this case, the company was Global Collect BV, which was incorporated in Netherlands, which was a holding company of an Indian company, which is Global Collect India Private Limited. And there was an agreement, service level agreement between Global Collect India and Global Collect BV, that pursuant to which this Indian company collected funds in its bank on behalf of the overseas merchant for sale of products and services to Indian customers. Now, in this case, Indian company, there was you see the whole business is around a transaction that Global Collect BV will, through its overseas merchant, will sell the things to the Indian customers, and the Indian subsidiary will collect the payment on behalf of the foreign entity. Now, if you see, this transaction could not have been undertaken. This service level agreement which was there between the Netherlands company and Indian company could not have been there. So the transaction is void ab initio only, because section 3 subsection C of the Foreign Exchange Management Act clearly stipulates that the no person in India shall receive any payment on behalf of a person resident outside India, otherwise than through the authorized dealer. So this type of a transaction where the person is fetching and collecting payments on behalf of the person resident outside India, it's void ab initio. So this transaction could not have been undertaken. So if there is a due diligence activity which is undertaken before the transaction or after the transaction, or as a corporate exercise, it always serves a purpose. Now let us see another transaction. Now in this case, the company X Limited was an exporter wherein it exported the goods to DPX, and DPX then X Limited was a subsidiary of X Holding. X is a big group, and XS Holding LLC is another associate company of X Limited. DPX and X Holding had this master agreement under which all the subsidiary of X Group, all the subsidiaries or all the associate companies of X Group will render the services to DPX. However, the money shall flow to X Limited. So rendering of services will be to DPX by X Limited India. However, this money will flow to X Holding. Now, in this case, if you see, if we see this transaction, even if the law, what does the law say? Law says that the money, once the goods or services are exported, the money needs to be received within 9 months. So in this case, DPX is sending the money in 9 months to X Limited. However, the law further says that the Indian entity, so the law says that the Indian entity is required to realize and repatriate within the specified time Further, it says that the receipt and payment regulation, it says that the person in India shall not do anything which delays the receipt of foreign exchange earning. Now, in this case, if you see, DPX is sending the money to X Limited, and X Limited bases the requirement of X Holding. X Holding bases the requirement of X Limited, it's sending the money to X Limited. Now, this will amount to delay in receipt of foreign exchange earnings, and hence this transaction, this agreement between X Limited, DPX and X Holding could not be entered into. So this transaction will become void ab initio. Another point, so we are discussing why the exercise of the due diligence. Another point and relevant thing that happens if by undertaking the due diligence exercise is that the due diligence exercise can trigger the compliances which can be done and which can be done as a corrective mode. Now let us see a scenario wherein the investment in UK entity is made in 2020. Investment was of £100. Now PQR Limited is shown in as a subsidiary of Indian company. However, no such reporting of whatsoever nature is done till date. XYZ Limited has invested in PRQ Limited outside India. So, as per the OI regulations, as per the OI rules, as per the new OI regime, there is a requirement of, as per earlier regime, there was a requirement of form ODI to be filled, APR and FLA. Now, this is not done. This is not done. If this entity called XYZ Limited takes a due diligence exercise, then a corrective solution can be offered to this entity that there is a window of LSF which is still open, that the entity can use for a period of 3 years from the date of from 22nd August 2022. So if these type of if due diligence activity is undertaken, early suggestions can be made to the entity, and lot of non-compliances which are there can be rectified. So this is LSF. We all know that LSF now is an opportunity which can be used by the entities, and especially I would suggest that the entities which have made the ODI investments earlier and which are sitting on the non-compliances as on today, they have a window of 3 years which they can use to to make good their non-compliances by way of late submission fees only. So this late submission fees, the late submission fees, it was not an option available till 2017 for the foreign investment, ECB in 2019, and in ODI, this option has come effective 22nd of August 2022. And this is available for 3 years. So an exercise should be undertaken with regard to compliances, and if there is non-compliances with regard to reporting. So LSF can be used only for non-compliances with regard to reporting. And if there is any non-compliance, it can be made good by filing the LSF. Another example, which we can see that early action can be taken for the transactions it triggers early correction. So we all know that export proceeds needs to be realized within certain period, and those of the professionals who are dealing in the companies which are exporting or which MNCs, they all know that how rigorously the export proceeds are followed by the AD bank. And we all know that sometimes it may so happen that because of the various reasons, the export proceeds are not realized within time, or they need to be written off. So a due diligence exercise will give a trigger point that okay, the exports is lying, there is a balance sheet item which is sitting on the balance sheet and which says that the export receivables are getting 4 months older, it's getting 5 months aged. So in that scenario, an early action can be taken and early suggestion can be given to the management, that first of all a trailing audit trail needs to be built, that maximum possible efforts to realize the foreign exchange have been taken, or any other action which may be possible, like set off of export receivable or application to AD bank for extension of time, or to RBI, or reduction in invoice value, or self write off, or application to RBI for self write for the write off. So any of these actions will be possible only if an earlier proactive action is taken. So if you approach AD bank after 3 years of aging of export, AD bank will also not be able to do anything. So, and why again, why the non-compliant, why the due diligence exercise? Because it also saves the company from the cost of non-compliances. Now, cost of non-compliance, as far as FEMA is concerned, is huge. Now, in terms of Section 13, if any person contravenes any provision under the Act, or rule, or regulation, or notification, direction, order issued in exercise of the power by the RBI or central government, in that case, he can be adjudicated and he shall be liable, or he can be made liable to a penalty. Can you beat the amount? It is thrice the sum of such contravention. Thrice the sum of such contravention. So if you have remitted $3,000, it is $3,000 into three, to which the penalty under this act can be levied. Now, in and this is where the amount is quantifiable, and it can be up to 2 lakh INR, where the amount is not quantifiable per day. So this is the amount of this is the amount of financial burden, and I'm not talking about the reputational loss or the brand uh, effectiveness, brand, the way the brand is affected, which comes with the non-compliances, and we have already spoken about the transaction which can be rendered void ab initio, etc. And if the compliance, if the contravention belongs pertains to Section 4, it can also lead to imprisonment beside the confiscation of the assets. Let me emphasize it here that FEMA is not revenue law. It's mainly a compliance law, which means the purpose of law is not collection of revenue. So if you are complied with, if an entity is complied with, there is no purpose of the RBI, central government, ED to come after the entity. The whole purpose is to make the compliance, is so that the and major, if you see, the major compliances under the act are of procedural nature. More and more compliances are becoming a procedural nature, and out of 100% of reportings that we need to do under FEMA right now, almost 60% of them have gone online. So it is just a matter of right guidance given, and right understanding of the law that is needed to make the compliance. Now coming, this was all the reasons that we have regarding why an entity should undertake this exercise of due diligence. So it ranges that the Indian currency is convertible, partially convertible currency. FEMA has extra territorial jurisdiction. It's a very dynamic law. It's complex. And due diligence exercise triggers early corrective action. It render And non-compliance not only leads to the penalty, but it also renders the transaction, it may also render the transaction void ab initio. So hence the exercise, hence it makes all the reason of undertaking this exercise of due diligence. Now, when we are undertaking the due diligence, it is the documents which may be called for are the regular document, but if you see, there are other documents which are in addition to our usual due diligence exercise, which should be called for. So the documents which can be vetted, like the balance sheet, charter documents of the entity. Now, charter documents like memorandum of association of entity, a shareholder agreement. Now, the things that we can get hold of, the pointers that we can get hold of from each of the document will be different. Now, we have statutory registers, form ECB, compliance certificate, managerial remuneration contracts like ESOP or insurance, like and then we have financial agreements that we should call for. We should look into the shareholding pattern and background check of KMPs, etc. Now, if you see memorandum of association of company, what will that memorandum of association of the entity will give? So we all know that memorandum have the object clause, and from object clause we know what the entity is pursuing in India, what the entity is pursuing in India. Now, if that particular object clause, that particular activity falls within the activity which is automatically allowed in India, for which only reporting is required, or is it falling in sectors like print media, broadcasting, uh, to certain extent in as it is defined in FDI policy, where the prior approval of RBI is required. So those type of trigger points can be undertaken from the memorandum of association of the company. Now, the subscription sheet of the memorandum may be seen to understand the subscribers to memorandum, to understand if the entity is promoted by foreign individuals or entities. Now, in case of 100% automatic route, the company may be promoted by foreign entities or individual having 100% shareholding. However, in the sectors which have cap, and in which there is a limit of percentage, they will have to compulsory move in the Indian joint venture partner, and so those things needs to be seen. Now, another charter documents like a shareholder document, what can be, I mean, besides everything else, for example, if the existing investor is a foreign entity and the shareholder agreement mentions of the deferred payment of consideration. Now, that deferred payment of consideration, we know that the deferment of consideration can only be till 25%. So all those things needs to be seen. Now, from statutory registers of the entity, we can understand there are so many statutory registers that the Indian company needs to maintain. And there can be things like transfer of from resident to non-resident, non-resident to resident. Now, if these are the transactions which triggers the compliance under FEMA, and those transactions should be seen. Now, Form 3CB certainly gives a lot of information with regard to the international transaction, compliance certificate, managerial remuneration, ESOP, if there are ESOP. Now, financial agreement should be, all the financial agreement of the company should be vetted thoroughly to understand if the loan has been taken from outside India, or if the loan is taken in India, which have been guaranteed by some non-resident. So a summary should be made, which should have everything like period, party, secured or unsecured, because that will give a complete conditions that for each of these summary points needs to be complied with. Now, whether it has been taken from the recognized lender, whether the all-in cost ceiling have been complied with, and whether it is being guaranteed by the non-resident. So, if even where in the cases it is guaranteed by the non-resident. Not that it will trigger the compliance of Foreign Exchange Management Act immediately, but at the time when the guarantee is asked to be, when the guarantee is maturing, in that case, the compliance of Foreign Exchange Management Act may trigger. So these are the main documents. However, there are a lot of other documents which we can share in the chat box, or which I can request which can be forwarded to your mailing list. Now, how to approach structuring of transaction under FEMA, or how to approach the due diligence under FEMA. So before undertaking any due diligence activity, we have to categorize a transaction. All the transactions have to be listed, and then it has to be categorized into current or capital. All, if it is categorized as current account, it is allowed. All the transaction which is current is allowed, and all the transaction which are capital are not allowed. So this is something which should immediately trigger the compliances. So if it runs, we can have another so this is just to give the overview of the due diligence, that how, why due diligence exercise is important, and how to approach the due diligence exercise. When we are doing a comprehensive discussion with regard to this due diligence exercise, we'll understand the difference between current and capital account transaction as well. And because that is the epicenter which triggers all the compliances, all the reportings under FEMA. So to start the due diligence activity, what we have to do is to take the balance sheet. Now, we understand that you will be very astonished to understand that for each of the balance sheet item, there are compliances to be undertaken. Almost each of the balance sheet item. So for doing the due diligence of Foreign Exchange Management Act, the balance sheet approach can be followed. Now, under the balance sheet approach, each item of balance sheet, based on its nature, is seen for applicability of the Act and the compliance thereof. Now, item-wise item, if you go ahead, you will see that there are, for each item, there are compliance, there is a regulation to be followed that needs to be done. So how is it different from the Companies Act? From Companies Act, we know that the whole of the Companies Act is applicable to the company. However, under FEMA, it is driven by the transaction. Now, if you see the transaction issued and subscribed, fully paid up capital, we have to follow the NDI rules. Now, in NDI rules, if you see, what is a transaction? Transaction is your share capital. Share capital is coming from the foreign entity. In that case, this is the whole of the 7 trigger point that needs to be complied with. So one is that who is the foreign investor? We have second, what are the various banking, what is the banking channel that the entity has used for remitting the funds? Is it the proper remitting channel? Can a foreign investment in India come through the money changer? Can it come through FEMC? So those type of things should trigger immediately when you are seeing a balance sheet item of issued and subscribed fully paid up capital, wherein you see that there is a shareholder which is non-resident. Now, what is the Indian entity in which it is coming? Whether the shares are allotted within 60 days, whether it has been reported in form FCGPR, whether if not allotted, whether the money has been refunded within 15 days, and whether there is an annual compliance, namely FLA return, has been done or not. So what we are seeing here, that for each balance sheet item, you may find any of the you will find a particular regulation that needs to be seen. So if you see partly paid up capital, so there are partly paid up capital in the balance sheet. Now what is the regulation that needs to be seen. So for partly paid up capital, we know that if the pay shares are partly paid up, it needs to be complied within, it needs to be made fully paid up within 12 months. So there is again there is a compliance trigger that is happening, that it needs to be paid up within 12 months. So these type for compliances for each of the balance sheet item you will find, like you see compliance compulsory convertible current preference shares. So whether now under FEMA compulsory convertible preference share amounts to the equity instrument. So whether the provisions with regard to NDI instrument have been followed or not. If it is non-convertible, whether the borrowing and lending regulations ECB have been followed or not. So likewise, if you see for each of the balance sheet item, we have the regulations or rules given by the central government that needs to be complied with. If there is a, if the entity that you are doing the due diligence for has downstream investment, now whether that entity has filed form DI, whether the entity, how the investment has been made in that downstream investment, whether is it made from the internal accrual, or is it that you can see there that it is money has been borrowed from India. So those type of things, compliances needs to be uh, will trigger. So if there are ODI investment, whether the new OI regulation has been followed or not. So these type of transactions are needs to be seen. Whether, especially when we started, we discussed that due diligence exercise triggers early compliance. Now, due diligence exercise triggers early compliance means it is like if you see trade receivables, now there are debtors sitting, there are bad debts which are there. Now whether you can write off the your pay your investments outside India. So there are conditions for each of this. Okay, write off, restructuring, write off of investment, disinvestment, restructuring of your investment outside India is possible, however subjected to conditions. So all these conditions can be seen by following the due diligence exercise, and we can take the balance sheet approach for doing the due diligence exercise. And not only that, the balance sheet items, but the items which are falling under the contingent liability may also trigger the compliance of FEMA. Now, due diligence report can have this scope of work, scope limitation, purpose, period under review, process undertaken, and findings. And when we talk about findings, findings should basically be in the form of three: corrective in nature, cautionary in nature, or recommendatory in nature. Now, in corrective in nature, under that heading, those transactions should be placed in which any contravention of law has taken place, where the law has not been complied with or fully complied with, or where the where corrective action is required with immediate effect. We can have cautionary in nature findings. Now, under the heading, those cases should be registered where attention of executive committee is required, and there may be recommendatory in nature findings which are put to the management as suggestions, and which are not the non-compliance as on date, but it may amount to the non-compliance. So friends, this is all that we have on the snapshot and overview of the over of the due diligence under FEMA today. And this is, I'll take the questions for another 6 minutes, because at least for today, we have a hard stop at 5. So I am going to share the PPT. Please, no one needs to worry. And you all know, in any case, that you can always write to me, and we'll take up your questions. So I'm going to see a few questions that is possible. So yes, FLA return. So Mahadevan, yes, FLA return can be revised on the basis of audited financials. That's always the case. So where the amount is not quantifiable, Sudhakar, if you see, for example, where permissions were required to be taken and those permissions are not taken, so amount may not be quantifiable there. Where the in so all those type of cases, and there's so many. For example, there may be reportings which are export proceeds are not realized, and so those will amount to the amount where is not quantifiable. And okay, to start a due diligence in case of a startup for investment from outside India, what prerequisites are required to see and what documents serve as the backbone of this process? So Mr. Tiwari, let me take your question. To start the due diligence in case of a startup for investment outside India, what prerequisites are required? So first of all, valuation will you need to do take the valuation of an entity outside India where the investment is done, the mode of investment, and if the startup is a company, if the startup is a company, it will be it will need to see that how much of investment is required to be done. And so from outside India and from compliance perspective, I think Amok, it's more of a business perspective that should be considered by a startup, because as such, apart from the reporting requirements and apart from the limitation on the uh, commitment, financial commitment that a startup can make, there are not too many of restrictions. In fact, Amok, now the so-called round tripping that we used to call has also been allowed. So a lot of startup, it's a very good opportunity for startups to explore outside India, because there is no restriction on going outside and then investing in India. So those things can be explored. Vani, opportunity in this field for CA, there are uh, there are n number of opportunity, from advisory to certification to due diligence exercise, and to the compounding applications. So there are a lot of opportunities. However, I would suggest that this due diligence exercise should be undertaken by every multinational entity. So time being less today, we could start little late, and for today only I have a hard stop at 5. So we could have done a more detailed exercise, but I hope I could at least do the justice by bringing in the reasons, various reasons that that due diligence exercise should be undertaken by every multinational entity in India. In India, maybe as an exercise, if you are already present in India, as well as if you are looking to invest in India. Vani, there are lot of. So I would rather suggest that you will have my email ID and you will have my number, so you can ping me. I will share that with you. So if there are more questions. Okay, Kanwal, with whom compounding application is required to be made, and is there any particular form? So, as such, the application is required to be made in a plain form, and there are, so as such, if you see, the regulatory body to which the compounding application is required to be made is RBI. However, the powers of RBI in a lot many cases with regard to reporting requirement have been delegated to the regional offices. So in certain, like for example, in case of a LOBO, it has been delegated to the Delhi regional office. So Kanwal, there is a particular regulation with regard to the compounding application. It depends on the type of contravention. So Jay, I'm going to take your questions. Please don't worry. Yeah, okay. What I was, yeah. So I was saying that it depends on the type of contravention. Uh, Only one thing which I can say about compounding application, that the more clearly that you lay down the contravention and categorically 1, 2, 3, 4, 5, because one transaction may have 6 non-compliances, and only those non-compliances will be compounded which are mentioned in the compounding application. So you must put all the non-compliances. So, for example, if it is a non-compliance with regard to the ODI transaction, so it may have that, okay, form ODI is not form FC is not filed, form FLA is not filed, APR for these many years are not filed, or maybe you have to go deep into the non-compliance and look into that. So I'm taking a few more questions. At, okay, I'm taking Jay's question. So X Limited Holdco and Y is boss. X can give corporate guarantee to Y for 5 years. Yes. So X is a holdco and Y is a boss. So see, for corporate guarantee as well, your ECB guidelines are required to be followed. And if it is following that, it can be done, because that's a structured obligation. So how do we identify the transactions for capital investment, long-term deposit given, short-term deposit given for purchase? Whether the entity can change a capital investment to long-term advance by submitting revised document, capital investment to long-term investment. I don't think so. See, what I'm assuming, that your capital investment is by way of what? Can you please tell me, Anil, if you can please tell me, what is your capital investment by by way of what? So depending on the capital transact investment, I don't think so it can be converted into long-term advance, because, and also long-term advance is no, Anil, it is not convertible. Investment in share into long-term advance, no, it is not. In fact, investment into loan is not, it's not convertible only. Once you have invested, you can only disinvest. Okay. So rest of the questions, I would just request that you can, if you can just write to me. I'll be very obliged to you if you can just put it in writing, because this was a short uh, webinar to take care and to understand the need of the due diligence under FEMA. So thank you all for joining in, and we are going to share the PPT for sure. And those questions which I am not able to take, I am very sorry for that. I would request that you please send them to my mail ID, which I have already shared on the screen. And yeah, I'll just share it once more. So if you have this mail ID, okay. So, okay, thank you everyone.